Now speaking, Jeff Norris, Senior Vice President, Chief Financial Officer. Thank you for the introduction. Welcome everyone to Capital One's second quarter 2023 earnings conference call. Today, we will be discussing our financial performance for the second quarter of 2023. Our Chairman and Chief Executive Officer, Mr. Richard Fairbank, and our Chief Financial Officer, Mr. Andrew Young, will be walking you through the presentation. Highlights from the second quarter include a net income of $1.2 billion, a return on average assets of 1.3%, and a return on average common equity of 11.7%. We also saw an increase in total loans of 8% year-over-year and a decrease in net charge-offs of 10% year-over-year. We are pleased with our performance and look forward to continuing to provide our customers with the best products and services. Now speaking, Andrew Young, Chief Financial Officer. Good afternoon, everyone. I'm pleased to report that Capital One had a strong second quarter, with pre-provision earnings of $4.2 billion, up 7% from the first quarter and 16% from the year-ago quarter. Revenue increased 1% driven by non-interest income, while non-interest expense decreased 3%. Provision expense was $2.5 billion, with $2.2 billion of net charge-offs and an allowance build of $318 million. The allowance balance increased to $14.6 billion, resulting in a total company coverage ratio of 4.7%. Our liquidity reserves decreased by about $9 billion to $118 billion, with a preliminary average liquidity coverage ratio of 150%. Net interest margin was 6.48%, 12 basis points lower than last quarter. Common Equity Tier 1 capital ratio ended the quarter at 12.7%, approximately 20 basis points higher than the prior quarter. Our preliminary stress capital buffer requirement is 4.8%, resulting in a total Fed capital requirement of 9.3%. We continue to estimate that our longer-term CET1 capital need is around 11%. Now speaking, Rich Fairbank, Chief Executive Officer. Good evening, everyone. Capital One had another strong quarter of top-line growth, with purchase volume up 7% year-over-year and revenue up 18%. Revenue margin remained strong at 17.76%, despite a 40 basis point decline from the prior year quarter. This was driven by loans growing faster than purchase volume and an increase in charge-offs. Domestic card charge-off rate for the quarter was up 212 basis points year-over-year to 4.38%. The 30-plus delinquency rate at quarter end increased 139 basis points from the prior year to 3.74%. Non-interest expense was up 8% from the second quarter of 2022, driven by higher operating expense, partially offset by a modest year-over-year decline in marketing. Consumer banking revenue was up 8% year-over-year, driven by deposit growth. Auto originations declined 31% year-over-year, resulting in consumer banking ending loans decreasing about $4.3 billion or 5% year-over-year. Commercial banking ending loan balances were down 2% compared to the linked quarter. Second quarter revenue was up 3% from the linked quarter while non-interest expense was down about 9% from the linked quarter. The commercial banking annualized charge-off rate increased to 1.62% in the second quarter. Capital One is investing to build and leverage a modern technology infrastructure to drive growth, efficiency improvement, and enduring value creation over the long term. Goldman Sachs analyst Ryan Nash inquired, Rich, Andrew, what is the trajectory of the margin going forward, taking into account the tailwind of card loan run faster and the headwind of rising deposit costs? What are your most updated expectations for deposit betas? Andrew Young replied, in response to the question about NIM, there are headwinds from deposit beta lag, wider wholesale funding spreads and revenue suppression. However, there are also tailwinds such as seasonally lower revolve rate and card, elevated cash levels and an extra day in the quarter. The trajectory of NIM will be largely determined by what happens to deposit beta. Goldman Sachs analyst Ryan Nash inquired, Rich, what are you seeing with consumer credit? Delinquencies have risen 130 to 140 basis points in the past 4 months. How far past 2019 levels could losses go and what does this mean for the allowance? Rich Fairbank replied, thanks, Ryan. Domestic card delinquencies in Q2 were 10% higher than the same quarter of 2019. Charge-offs are still below 2019 levels, but we expect them to rise in the coming months. We're seeing a deferred charge-off effect, which is the reverse of what happened during the global financial crisis. This can't be measured, but it's likely due to the low unemployment rates. We feel good about our credit performance and are leaning into growth opportunities. Andrew Young replied, Ryan, with respect to the allowance, it's all about our outlook for losses and loss rates a year out. We're taking into account future growth and other factors that Rich just described. These dynamics will have the biggest impact on the allowance, especially as we look out into 2024. J.P. Morgan Chase & Company analyst Richard Shane inquired, Rich, where do you see the greatest opportunities for Capital One to deploy capital and grow in the near future? Rich Fairbank replied, "We have always been enthusiastic about the card business due to its industry structure and the opportunities it presents for information-based and technology-based strategies. We carefully evaluate the industry structure and marketplace before making decisions, sometimes taking a different approach than others. We see several reasons to be optimistic about the card business. Firstly, consumer credit is in a strong position, and consumers are in a healthy financial state. Secondly, while competition in the card industry is intense, it remains rational, with credit choices being made responsibly. Additionally, margins are strong, and we observe positive metrics in terms of credit performance and marketing programs generating new accounts. In comparison, the auto business has faced challenges, particularly in passing on increased costs to customers, but we see some opportunities emerging. On the commercial side, our focus has been on the office portfolio, and we have taken steps to address areas of higher stress. Overall, we are leaning in the hardest on the card business, as we see significant potential and positive market conditions." Bank of America Merrill Lynch analyst Mihir Bhatia inquired, "Could you please explain what drove the decrease in expenses quarter over quarter and how you anticipate expenses to progress through the year?" Andrew Young replied, "Mihir, Q1 to Q2 saw a seasonal effect in compensation, payroll taxes, and benefits. This was the largest single factor impacting our ST&B line." Bank of America Merrill Lynch analyst Mihir Bhatia inquired, "Do you expect Capital One's NIM to return to the high sixes, or has something changed in the business that would prevent that?" Andrew Young replied, "Mihir, there's no fundamental change in our business. Consumer behavior and the Fed's rate decisions could affect our net interest margin, but nothing has changed from years ago." Morgan Stanley analyst Betsy Grisek inquired, "What opportunities exist to maximize return on marketing dollars given the need for people to borrow more than in the past?" Rich Fairbank replied, "Thanks, Betsy. Our marketing was flat compared to the prior quarter and down 12% year over year. We're leaning into the marketing to capitalize on attractive growth opportunities across our business, particularly in the card business. We've also been investing heavily in heavy spenders since 2010, and we're seeing increased traction and purchase volume growth at the higher end. Lastly, we're investing in building our national retail bank, leveraging modern technology and a compelling digital experience. All of this marketing is the engine behind this, and we continue to lean into it and be very pleased with the performance." Morgan Stanley analyst Betsy Grisek inquired, "What are the growth rate expectations for the post-COVID environment?" Rich Fairbank replied, "Marketing is the engine that drives our card business growth. We focus on balanced growth and purchase volume growth, but they are not one for one. Since the founding of the company, we have been focused on building an organic growth engine through originations and leveraging our technology and analytical capabilities. This is why we are leaning in hard to marketing. It is the foundation for continued outstandings and revenue growth." Keefe, Bruyette and Woods analyst Sanjay Sakrani inquired, "Andrew, what is your forecast for net charge-offs going forward and what is the unemployment rate assumption in your current macro baseline?" Andrew Young replied, "Our baseline assumption is that the unemployment rate will increase from 3.6% to 4.3% by the end of this year, and remain in the 4s through 2024. We are also considering downside scenarios that are more severe than the baseline. Our models focus on the rate of job creation, which we are forecasting to be nearly zero. We assume higher losses in the second quarter of next year than the quarter we just left, and delinquencies are the leading indicator to charge off, especially in the near term." Keefe, Bruyette and Woods analyst Sanjay Sakrani inquired, "Rich, what makes the current growth in card attractive compared to the past? What are the risks associated with this growth?" Rich Fairbank replied, "Sanjay, there are certainly things to be concerned about in the economy. Credit normalization is occurring, and while credit is still attractive, it's rising. The market is competitive, but the U.S. consumer is a source of relative strength. Labor market has been resilient, debt servicing burdens remain low, home prices have started to rise, and consumers have excess savings. The big negative is inflation and real wages have been pushed down. Payment rates have been strong throughout the pandemic, and our recent originations are consistent with pre-pandemic risk levels. We are managing reactively and proactively around the edges to ensure performance is not compromised. We are leaning in, but we are watching carefully as the industry is also leaning in." Wells Fargo Securities analyst Don Fendetti inquired, "Rich, what have you observed regarding credit card spend growth rates on a like-for-like account basis? Do you anticipate further moderation?" Rich Fairbank replied, "Domestic card purchase volume was up 7% year over year, driven by growth in our customer base. However, spend per customer has moderated and is now generally flat from a year ago. This moderation appears to be broad-based across income bands, card segments, and both discretionary and non-discretionary categories. We believe this is a sign of rational and healthy behavior on the part of the consumer. Payment and revolve rates are normalizing, but still not at pre-pandemic levels, indicating underlying strength." Citi analyst Dominic Gabriel inquired, "What mistakes do you think card issuers and lenders make when the credit cycle turns?" What signs do you look for to give you caution? Rich Fairbank replied, Yes, Dominic. I appreciate the question. The credit cycle and the economy are closely related, but they are not the same. During the pandemic, we saw an extraordinary period of credit quality, which resulted in high returns for our investors. However, with every passing month that this cycle is abnormally good, there will be a price to pay on the other side. We saw a surge in fintech lending, particularly to subprime customers, which was alarming. This was exacerbated by credit scores that had drifted dramatically and savings rates going up for consumers. Common mistakes made by fintechs were leveraging technology and building models based on the greatest credit economy in history. We have intervened in our own modeling and put heavy reliance on data from the last few decades to get past this. Now, we are seeing a normalization, which is a healthy thing. We are also keeping an eye on the CFPB's efforts on late fees, which could reduce late fees by 75%. This could have a significant impact on our revenue, and we are looking for solutions that maintain a winning customer franchise. Do you have another question? Citi analyst Dominic Gabriel inquired, Can you provide some insight into the professional fees and salaries, and was there a gain in the other non-interest income from the sold portfolio? Andrew Young replied, I believe you have a good understanding of our investments in technology and third-party resources, as well as our recruiting brand. We saw a decrease in labor costs due to these investments, while non-interest income saw an increase due to agency income in our commercial business. This quarter-over-quarter increase was driven by the strength we saw in the quarter. Jeff Norris replied, Thank you all for joining us on the call today. We appreciate your interest in Capital One and are happy to answer any further questions you may have. Have a good night.